I'm bullish on most commodities across the board. My focus has generally been on, say, oil and uranium. But for me, it's an all of the above. I think energy in general is going to have a bull market. Copper is more cyclical, so that's been a little bit more pressured. If I was not bullish on gold, I wouldn't necessarily go out and buy gold just because of what happened this weekend. I'm long-term bullish on both gas and coal. Some commodities I'm already long. I've been sitting in uranium for 3 years. So instead of taking, say, a small position in a miner, I might take a bigger position in the uranium itself. Bearer assets, I think, are worth owning in general in this environment. Energy companies are the new banks.
All right, how's it going, everybody? Back today for some macro talks with Lyn Alden, who obviously everybody already knows who she is. But what you might not know if you were living in a ditch somewhere is that as of recently, she's a best-selling author with her new book, Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. So, yeah, Lyn, I guess, first of all, thank you for being here, obviously. But I don't know, like why can money be broken? What's going on?
Happy to be here. Thanks for having me. And I wrote Broken Money because I spend, hours every day analyzing the global financial system, explaining how to invest into it, explaining why certain things are not working, why certain reactions are going to come. And I wanted to give people a more holistic picture of kind of the history of how we got to this current state, why the current state's unstable, and then some of the directions that things seem to be going in with kind of a major fork in the road ahead. And so I think the semi-short answer for how it's broken has to do with the advent of the telecommunication age. So once people invented and deployed the telegraph in the second half of the 19th century, we've been in this environment where transactions can occur at the speed of light. Because transactions are just information. We can send information around at the speed of light. We can make transactions. We can make all sorts of deals. But physical settlement of money like gold still moves and gets verified at the speed of matter. And so ever since we opened that big speed gap between transactions and settlements, we've necessitated the use of credit to bridge that gap. And then it leads to centralization. It leads to central banks having a lot more control and influence. And eventually got to the point where they were able to drop gold entirely from that system. And so we basically went from relying on kind of gold as our foundational ledger to relying on these centralized ledgers to kind of, keep an accounting track of things and move things around quickly in a digital age. But that obviously has all sorts of downsides. And the most stark way I think of painting that picture is that there are approximately 160 different currencies in the world. And the top handful do okay. They just lose value slowly, whereas the long tail of smaller, weaker ones generally lose value very quickly, with many of them hyperinflating in our lifetime. But even ones that don't hyperinflate, if you're diluting at double digits almost every year, it's very hard to build liquid capital. And so that obviously can't be the maximum point of money to have 160 different kind of little currency bubbles. Each one's a silo around their borders. Most of them have little or no acceptance outside of their own jurisdiction. People kind of do a dice roll to see what currency environment you're going to be born with, and then that's your unit of account, that's your savings. And so recent technologies, Bitcoin, stable coins, things like that are starting to break into these different silos. But that's maybe a different point in the discussion. But basically, we're money's broken in large part because technological limitations have kind of forced it to be centralized and abstracted, and then therefore it gets corrupted.
I'm just trying to relate this to the only point in my history that I've been in touch with hyperinflation. That's kind of crazy sounding to people from North America because that doesn't happen all that often there. But I was born in Bulgaria in the late 90s. And so it was, I was a baby at the time, but I remember the stories that my mom has told me about the hyperinflation that went on there. And so, she would have money in the bank for next rent's, basically next rent's money. But then it turns out she wakes up one morning or the next week or whatever, and she can't even buy a bread with that. But so in your book, you also talk about how basically what you just told me, that being born in the quote unquote wrong country, or at least when it comes down to maybe not being born in a country that has reserve currency, or a country whose currency has existing demand for it outside of the country's own borders, which is not the case with Bulgaria. Well, that makes saving money harder than it needs to be, which is in and of itself obviously hurts the potential for financial progress and well-being. And that has absolutely happened to my parents, who were very poor after that. They had to sell their golden wedding rings to pay that rent that I was talking about. But so what is a practical solution to that? What are people outside of the US supposed to do with this information? What could have my parents in the 90s in Bulgaria done to protect themselves against that hyperinflation?
So there's a couple different things that they try to optimize for. One is saving, which is somewhat more manageable, and the other one is unit of account, which is harder. And so when it comes to saving, it's making sure people understand the dilution effects that are against them. And I just came back from Egypt. A lot of my family's there. We had a lot of discussions there around Egypt's current financial troubles because they're growing their broad money supply by about 20% per year, almost every year for the past decade and counting. And so the way I explained it is, and people often just see the CPI, or they just see like a dollar peg, which is sometimes artificial. Whereas looking at the actual broad money supply growth, I think gives you a bigger picture because, if you're an Egyptian, for example, and you're not getting a 20% raise every year in local currency terms, you're getting diluted. Like your share of the pie is diminishing and you're getting diluted out of this monetary network. And that might be not be apparent in 1 year or 2 year or 3 years because you can do all sorts of pegs and things like that. But eventually pegs break, and eventually inflation surges, and you find yourselves diluted. And so back in kind of the pre-telecom era, when countries wanted to base their currency, it was a very slow process because if you held coinage, a king or ruler, the only way to really debase it was they had to, tax it in, remelt it, and then redeploy it in larger numbers in a diluted coin. And that's necessity, like a slow process. Whereas when you have either gold-backed currency or you have just fiat currency, you can just kind of print a lot of money overnight, and anyone holding that can get rapidly diluted. And so the first step is mainly to focus on real assets. Most people in these economies understand that. They understand that they have to own things like gold or dollars or real estate. The other hard part is just unit of account. And so to understand the magnitude with which they're being diluted, not just in terms of their savings, but that their ability to negotiate ongoing income streams. An example of that is there's a videographer in Egypt, and he does a lot of local stuff. He makes films, but the way he pays his bills is he does filming for foreigners, right? So if they need filming, like a company I worked with needed me to film something while it was in Egypt, so they hire this person, and we film something, and he charges in dollars, but by the time it hits his bank account, it's in Egyptian pounds. But that's actually okay because in his sense, what's important is the unit of account. So if he charged $100 a gig 2 years ago and he still charges $100 per gig, he actually held up way better than most Egyptians because the Egyptian pound was cut in half relative to the dollar within that time frame. And most Egyptians did not get a 100% raise in local currency terms. Therefore, they're making fewer dollar equivalents per hour than they were before, whereas he's still earning the same dollar equivalents per hour. He just has to make sure that when that money hits his bank account in his local currency terms, he goes out and buys something more scarce with it. And so both savings matters, unit of account matters, and then I think newer technologies matter, right? So for example, people in Argentina and Nigeria make extensive use of things like stable coins, sometimes Bitcoin if they can withstand the volatility for longer stretches of time. Whereas in a lot of other countries like Egypt, that technology is not really caught on, and then they have trouble accessing dollars. So there are some of these newer technologies that can start piercing the veil more, kind of start piercing the capital controls that countries do their best to erect around their borders. And I think leading into those provide some longer term hope. But the unfortunate answer is there's no easy near term solution for a lot of people. And I think just having a better education around money, monetary history, monetary technology, I think is important for everyone, and it allows them to be more informed about what's happening around them.
That is, it's interesting what you say about the dollars. To sort of go back to the my previous example, my mom used to work in a hotel at the time, and when there were foreigners there, they would give them tips in dollars, and so sometimes their tip relative to their own currency was like 500% what they had expected
Yeah.
before, because the inflation in Bulgaria at the time, by the way, was for people listening, was more than 100% monthly. It was in the thousands of percents. I don't remember exactly on an annual basis. So it is hyperinflation as it is. And so that happens. And also the little bit of gold that they had basically saved the roof above their heads. But there was also a shortage of dollars at the time. So it was just not, from what they've told me, it was just not easy to get your hands on dollars. You couldn't just as easily go and convert the Bulgarian lev at the time to dollars. Is it possible for the US to head down that hole? Like, is it possible for the dollar to go through hyperinflation, or is it gonna die a slow death?
So it's possible, but it's a lot harder.
Mm.
Basically, when there's foreign demand for a currency, and not just like optional demand, but all dollar-denominated debt outside of the country represents demand for dollars because you need dollars to service your debts. You have contractual demand for dollars, and so that's $13 trillion in kind of like transparent value, probably a little bit more than that when you look at all the books. So there's trillions of dollars worth of demand for dollars. And so that's number one. Um, Number two is that usually when you see hyperinflation, it's due to one of a couple things happening. One is either the industrial base was heavily damaged by a war or communism, like some sort of massive breakdown in either physical infrastructure or kind of social infrastructure. Um, or number two, you have liabilities that you can't print. Like in Weimar, they had war reparations in gold, for example. And when you see emerging markets today hyperinflate or nearly hyperinflate, the Argentinas of the world, the Turkeys of the world, it's often because they have dollar-denominated debt, which they can't print. And so they end up encountering like major default risk and things like that. And so developed countries have the privilege of having most of their liabilities or all of their liabilities denominated in their own currency, which allows the smoother kind of dilution over time rather than these harder breaks. So in general, it's much harder for a developed country to experience hyperinflation unless it has an absolute major breakdown in infrastructure, energy security, or just massive political instability. So my base case would be more towards a slower death in the sense that you run above target uncontrolled inflation for a while. So it's kind of directionally similar, but not necessarily, the same shock and all magnitude that we see a lot of times in developing countries.
And this is sort of the conclusion among most, if not even all analysts that I interview. Even Bryn Johnson has said, as people know, in the milkshake guy, he believes that eventually that is also going to happen. I've not heard sort of the opposite opinion of is it possible? Is there something the US could do to still sort of, I don't know, heal or save the currency where, okay, maybe it doesn't go back up in value because that would be deflation. That would have all the other problems. But would it maybe be possible to sort of keep it steady? I mean, at a flat rate, basically, if that makes sense.
So in general, it's an unstable system. And so, for example, over the past 40 years, we've had rising public debt as a percentage of GDP, which has been offset by structurally falling interest rates for those same 40 years. And so public interest expense was managed that whole time. It wasn't really getting too bad, especially as a percentage of the economy. But once we kind of bounced off zero, while we still have very large debts growing, and now we have demographics accelerating those debts, right? So baby boomers, instead of being net contributors to Social Security as they were, now they're net, receivers from Social Security. So Social Security fund is winding down. That's pushing more and more of the kind of the longer term liabilities into actual liabilities. Um, Basically, we have a situation where interest expense is much harder to control now. And so you risk having a fiscal spiral, or you risk kind of Japan's case of financial repression. where you hold rates purposely below the inflation rate. But it's in some ways harder for the US to do that because Japan's doing that from a position of a positive net international investment position. So they spent decades having trade surpluses, current account surpluses. They own a lot more foreign assets than foreigners own of their assets. So they actually have a gigantic piggy bank that they can sell to buy oil, defend their currency, whatever they want to do with it. The United States, on the other hand, we're more powerful in a lot of ways, but in addition to our structural fiscal deficits, we have a structural trade deficit as well, a current account deficit. So, and that's after decades of that, foreigners own a lot more of our assets than we own foreign assets. We're very deep in the red in that regard. And so one of the things that foreigners do when they need dollars is they sell US assets. And so that's why, ironically, when the dollar strengthening, generally you see foreign sector reduce their holdings of treasuries, or at least stop buying treasuries, because they're more in terms of defending their own currency. So I view this system as relatively unstable. I think a wild card that could extend it potentially is ironically stablecoins, because even as you see BRICS currencies and countries trying to have a top-down approach to de-dollarize around the margins and things like that, the bottom-up desire from people in those countries is they generally want dollars if they can get their hands on them. And stablecoins represent a way to get dollars sometimes more easily than they can get physical dollars. Basically, it's like an offshore bank account for the middle class. And so they're still relying on a central issuer of those tokens. They're basically still relying on a bank, but that bank happens to be outside of their country. And so the more that stable coins proliferate, it's kind of like people around the world leaning into dollar assets. And the borders between those 160 different currencies start to weaken and become more porous, and more of that can gravitate towards the US ledger. I think that's like a wild card to kind of monitor to see how big stable coins grow, because that's a new source of demand that offsets some of the other waning demand. But in general, the instability of the US system and the European system and the Japanese system are directionally similar to emerging markets, just slower to unfold. So I don't really view a way that's, for example, the United States can have positive real rates indefinitely.
Hmm.
But I still think it's a long-term process.
But what you're telling me here is coming, at least in my mind, then dangerously close to CBDCs, and that sort of makes me, gives me goosebumps.
So generally I mean, me too, but basically when we have these sovereign debt crises in developed markets, that's generally when you see major monetary resets, recapitalizations.
Hmm.
And there's various mechanisms they can do that. Like the US can recapitalize itself by repricing gold. That's actually in the Fed handbook. It can be initiated by the Treasury. It's one of the few ways that they can spend without issuing debt, is that they can revalue gold higher. And that basically that balance gets put right in their Treasury general account. So central banks have that capability, and that could easily be paired with central bank digital currencies. There's one thing we've seen in some countries trying to launch these, like in Nigeria, the central bank digital currency has so far been generally a failure. The e-Naira. So they, for example, they blocked bank off rails to crypto exchanges. So they said, okay, it's not illegal to own crypto, but banks can't send money to crypto, right? So the frictions were made significantly. And in this case, crypto mostly means Bitcoin and stable coins. People speculate around the margins, but it's kind of that basically dollars or Bitcoin. Those bank off rails are blocked, and yet crypto adoption in Nigeria is way higher than the e-Naira adoption. And there's been all sorts of kind of pushback against that, the pushback against the reduction in paper bills. And so when these things are put on people and they don't really like it, it's proving challenging. The biggest threat, I think, would be that if most people go along with it. And I think in a lot of these highly polarized societies, I think it might be harder for people to go along with it than people think, because all they have to do is imagine their least favorite politician running the CBDC, right? So in America, if you're red, you just picture the blue guys running the CBDC. If you're blue, and that side's currently more in favor of the CBDC approach, imagine the red side running the CBDC. Do you really want that? If you're in Europe and you're one of the highly polarized, some countries want to leave the European Union, some people want to stick the European Union together. Just imagine whoever you don't like politically running the central bank digital currency in the next election, whatever, right? So I think over time, that's going to prove difficult for people to accept, but it is one of I think the biggest threats going forward. And basically, that's the fork in the road. So money's becoming more digital. And the major fork in the road is whether some of these more private or open source alternatives are going to win. So things like Bitcoin or tokenized assets that kind of, break down borders, allow for more, protection against dilution, protection against payment censorship, things like that. Or are these more centralized approaches going to win? Are the 160 different currencies of the world going to keep their local monopolies, solidify them even more, and basically further centralize control? So, most of the frictions in money we've seen over the past century and a half have been smoothed over by more and more centralization and abstraction.
Mm.
And the invention of some of these technologies is the first real window of opportunity we have to kind of break that cycle and actually decentralize things a little bit more, de-abstract things a little bit more, or they can continue the path that they've been on, which is even more centralization. And CBDCs would kind of be the end game for that trend.
So it's either so over or we are either so back,
Yeah,
TBD basically. Yeah, but no, it's kind of funny when you look at these places and you see how quickly black markets form in poorer countries relative to richer countries, where we just have so much more that could be taken away from us if we don't comply. So it's funny, and oftentimes when I mention something like that, people would comment, black market is the free market, and so that makes sense to me. But no, now I'm getting why I don't like CBDCs or why they give me goosebumps, because I dislike all politicians. So imagining that someone else has power of it is it's
yeah.
already painful. But okay, go back to the US. What's basically or how you would basically explain what's happening right now, as far as I understand it, is that high deficits and high public debts might work well until you add tighter monetary policy to the economic situation. Is that right?
That's correct. And more specific, more structurally rather than just cyclically, it's the fact that if your debt for 40 years, your debt accumulation was offset by falling interest rates, structurally, not just cycle by cycle, but literally structurally, when you bounce off zero and start going sideways to up, even if you have cycles that are up and down, you're no longer structurally going down. And so that interest expense becomes a larger and larger burden to deal with. And that becomes, unrecoverable.
Hmm. Well, what kind of a timeline are you working with here?
So think like, given recent events, wars and stuff like that can accelerate timelines. So this can be nonlinear, right? So left to its own devices, this is, I think, a slow grind. Basically, you're stuck with above target inflation for a prolonged period of time. Maybe during recessions it briefly dips down. But whenever you're not in a recession, I think we're kind of entering a period of more structurally high inflation for a period of time, just because the problem is when you have so much public interest expense, raising interest rates ceases to be an effective tool for controlling inflation. Because on one hand, you do push down some private sector lending, but then you also blow out the fiscal deficit even more, which is a source of money creation and inflation. And
Hmm.
so left to its own devices, I think it's a long grind. Now, but it cannot be left to its own devices in some sense, because if you have war, if you have spikes in energy supply, if you have disruptions in the energy supply, if you have major countries selling their treasuries and the things like that, there's all sorts of nonlinear things that can happen along the way while you're trying to slowly grind it down. But basically, I think that over the course of later in this decade and then within the next decade, we're going to see major turning points in terms of how the global monetary system is ordered, in terms of the dollar's role in the world, in terms of the dollar's ability to maintain purchasing power during this time. And so I think we're already underway, but it's a longer process with some kind of nonlinear points in the road.
When you're mentioning that wars can accelerate that, the breaking out of the recent war, as unfortunate as it is in the Middle East, has that changed your opinion on some of the calls that you've made so far this year?
Not particularly. I mean, if anything, like I've been bullish energy. Now we have a little bit more potential disruption in energy supply, for example. Um, and so generally wars are historically commodity bullish in a bad way.
Yeah.
Um, both in, either in terms of increased demand for those commodities or in terms of disrupted supply for those commodities. War is generally bad for highly valued financial assets. So either bonds at low yields or stocks at high equity valuations, those tend to be punished in terms of war. It's yet to be seen how significant this war will be for the major powers. Right now, it's more localized, but I think one way to think about it is that inflation leads to disorganization, and disorganization leads to inflation. And another way of putting that is inflation can contribute to war, and war can contribute to inflation. So basically, when you get productive deflation, it basically means that things are organized, they're working well, we're increasing supply, and that's good for prices. It brings prices down on a lot of things. Whereas when you have disorganization, war, the need for duplication of everything you're trying to do for security purposes, um, that's all else being equal, inflationary. And I think that that's kind of the structural regime we're going into, one of less order, more disruptions, more duplication, more resiliency, which is generally an inflationary outlook. And I think energy is still going to be a key important thing this decade.
Hmm. But Lynn, that can be. Paul Krugman just told me that we've defeated inflation, so something else is happening, surely. But
Generally, yeah, just generally during inflationary periods, statistically it tends to come in waves, right? So in the 70s, you had three major waves of inflation. In the 40s, you had three major waves of inflation. The 1910s were a little bit different because you just kind of had one big inflationary spike with the war, and then it kind of settled at a higher plateau. Um, Even in Weimar, if you look at like the price of gold in marks during that time, the central bank would fight back for time to time. They would like crush gold by like 80% and before, they wouldn't be able to hold it down anymore and it would spike again, right? So you'd have this instead of the smooth hyperinflationary trend, you had periods of fighting back. Um, and so it's not that we can't even, if you get a bad enough recession, you could even hit deflation for a period of time. The question is, when we try to have the next growth cycle, how do we get that without inflation coming back along with it? Or even if you don't have a growth cycle, you could run into outright stagflation. Um, and so I view it less as, okay, inflation's down, let's, kind of wave the flag of victory. Going forward, we still have structural deficits. We still have a lack of sufficient capex in the energy space, and the energy transport space. And so I think those things are going to be a recurring theme. Uh, you know, Maybe not 6 months from now. I don't know. That's more tradable. But I think certainly over a multi-year period.
hmm. In the way that the Fed has been fighting this with higher interest rates, but also drawing down on its balance sheet while also drawing down on reverse repo. I think you've recently written about that. Maybe even your last newsletter. I believe it came out on October 1 or something along those lines. You wrote about that. So you don't think that's going to work for too much longer?
So I mean, basically, they've already drawn down something like $1 trillion in reverse repos.
Hmm.
They still have over a trillion left. Maybe a year, maybe 6 months. We'll see how quickly they pull that down. Once the Fed runs out of reverse repos, that's kind of like a liquidity battery, right? So they're reducing their balance sheet, which is tightening. But any money that comes out of reverse repos and gets pulled back into the financial system is pro liquidity. And so we've been in this ever since the March banking crisis. We've been in this kind of equilibrium phase
Hmm.
of the Fed still trying to tighten, but also reverse repos are coming back on the market. Once the Fed no longer has reverse repos, it'd be very hard to maintain their balance sheet reduction, and their high rates, or at least both together, right? So I think the bigger constraint will be balance sheet size. You can technically hold rates at whatever you want as long as your balance sheet's flexible. But that's, if they get to a point where they're no longer able to reduce their balance sheet and they still have above target inflation,
Hmm.
that can threaten central bank credibility. That can be pro liquidity at a time when inflation is still an issue. So I think that that could be a trigger for the second round of inflation. It could be energy driven. It could be the Fed no longer being able to tighten because of Treasury bond oversupply. There are a bunch of catalysts like that that can trigger the second wave of inflation, or at least a bottoming of inflation and then kind of remaining at above target inflation for a prolonged period of time.
So what's left for them to fight that second wave of inflation with then?
Financial repression, unfortunately. So that's and they use that in the 40s. A lot of developing countries use that today. Basically, what they do is here's the problem. If you're in like the 70s, right? So you have low public debt, um, and when you raise rates, it slows down bank lending. And although it does increase the deficits, the public sector deficits, it doesn't like the downward push on the private sector is much bigger. And so that's disinflationary. But when you have over 100% debt to GDP, when you have very large deficits, raising rates, although it does put downward pressure on the private sector, the upward pressure on inflation from larger fiscal deficits from higher interest expense is equal or sometimes even higher. And so one of the things that they try to do in a financial repression scenario is they try to have fairly low costs for the government while still trying to restrict the rate of private sector credit growth. Because, if you have 5% inflation, but you're doing yield curve control, and so yields are capped at 2%, for example, then every private sector entity has a big incentive to go out and borrow that currency, right? Because if you're going to get a negative real yield on your loan to buy something scarcer, you're incentivized to do that. So then what they try to do is they try to hold down interest rates while also restricting sources of credit growth, which is financial repression. And so I think that's kind of the end game that they're going to try. But I think they're going to exhaust a lot of steps before they get to that point. But we already see, the bank term funding program is already a very mild part of that because they're basically giving privileged rates in some ways to treasuries and mortgage-backed securities while still trying to tighten the private sector.
I actually want to talk about the jobs market before you just told me that, because what we've seen right now was wage growth falling, meaning the risk for a wage spiral is not there anymore as it was before, while more jobs are being created. Now, whether you want to believe it or not, that's what the consensus seems to be. But isn't that technically a soft landing then?
So we've seen, on one hand, wage growth is falling, but we also just saw major, victories from UPS and other kind of these more union-based things. I think they're going to be very effective at securing higher wages. And that's going to be all else equal pro-inflationary. I think that a lot of these kind of real world work type jobs are probably going to see higher wages, which is going to feed back into margins, feed back into overall consumption power. Another factor we see is that um, the biggest, like right now, those over 65 spend more money than any other demographic group. And their money doesn't come from wages primarily. It comes from Social Security, it comes from their accumulated savings. And ironically, if you have higher interest rates, they often have more spending power, right? They're holding things like T-bills and money markets. And rather than earning zero, they're earning 5% now. And so you have to think when there's $2 trillion in annual deficits, who's earning those deficits, right? So it's generally the wealthy kind of upper middle class, upper class, it's the insurance companies, it's all these big pools of capital that either are receiving the payouts or that own interest-bearing assets, especially the shorter duration ones that did not take the big price hits. And so those are still very strong spending categories. The way that I would describe this is, when you look at a developing country, they often have what looks like a soft landing in the sense that they don't necessarily have a deflationary recession. They have a more inflationary recession or a more inflationary slowdown whenever they have a financial crisis of some sort. And so in the United States, I think, I do expect we'll have a fairly soft landing in terms of unemployment, meaning that even if we get an uptick in unemployment, I don't think it will be as severe as some of the recent recessions. Um, but at the cost of that, I think is going to be structurally above target inflation. And periods of financial disorder, with, for example, bond yields being problematic, highly valued equities being problematic. So I think the story is not yet finished in terms of the ramifications for what happens because, right now the Fed's still able to tighten, which is somewhat unsustainable given the ongoing Treasury issuance. So I think when we fast forward 12 months, 24 months, let's look back at this period and see if we can call this a soft landing or not.
It's funny how we, the people, always end up paying for the mismanagement at the leadership roles, either through taxes, increased taxes, which has just been happening on and on, or through inflation, which just seems to remain the case. And also, you make a very good point where higher wages for real world stuff, as you call them, real world jobs, is inevitably going to result in inflation too. And that's, I'm assuming, specifically going to be much more visible in the commodity space because I keep covering it each week on the channel, but there's far fewer mining engineers that are graduating. Far fewer people want to take up mining. Some of these mining jobs pay $200K a year, and there's not enough people to take them up. I interview company executives and so on and so forth that tell me the same thing. And where does inflation really start is actually in the mining, because everything we really touch on a daily basis comes from out of the ground, almost. So
Yeah,
there's
generally
that.
when you see inflationary cycles, they're always accompanied by energy and broader commodity
Mm.
bull markets. And that's just kind of the history of how this works. And so part of what makes inflation come in cycles is that commodity capex comes in cycles, So those necessarily have somewhat long lead times, right? So when commodity prices are rising sharply and structurally for a prolonged period of time, more capital starts pouring into the space, more supply starts coming in line with a delay, and eventually they are able to flood the market combined with some sort of demand reduction that generally happens in a recession or something. Then you have a period of kind of oversupply, lower prices, and then no capital wants to come into the space. The prior reserves start getting depleted. Demand keep inching up over time with population growth or with developing countries starting to develop more. And eventually they run into a part where it's tight again. And then
Mm.
that starts causing a bull market. And these are on like say 15 plus year cycles. And so the combination of having a lot of debt at the sovereign level, interest rates no longer going structurally down, that's the kind of the house of cards. And then what kind of hits that? The catalyst is commodity scarcity, energy scarcity, right? So when you have a commodity bull run, commodity capex cycle at a time when you have those very highly levered financial situation, that's when you generally get these more, kind of inflationary sovereign debt type of
Mm.
crises.
I feel like you just described the bull thesis for uranium, but it's pretty much the bull thesis for all the commodities. And I do want to get into commodities here in a second. But on the back of all this that we've been talking so far, I've been joking around recently, under the under the assumptions that bonds only go down, because recently that's all that they've been doing. And but in the spirit of that, how high would you guess the yield on the 10-year could get while the Fed is trying to fight this potential reflationary cycle?
I don't have a strong view on that, but I've been telling my readers that I'm not, although it's oversold, sentiment's very much against it. I've not yet been stepping in to say go long bonds because there's still no clear resolution to the large amounts of deficits that are coming to market, while the Fed's tightening and while foreign sector's not buying and while banks are not buying. So, there's a handful of major buckets of treasury demand. Um, and so that's, domestic banks, the Fed, for the foreign sector, um, households and non-bank domestic financial institutions. So things like insurance companies or asset managers. And right now, the Fed, domestic banks, and the foreign sector in aggregate are all on a buyer strike for various reasons. And so that leaves non-bank domestic entities have to absorb all of this. Um, and so I think once we run out of the reverse repo facility, maybe before then, but I think that's kind of the clock to watch. Um, this it becomes, I think the Fed eventually encounters something like their 2019 repo spike, where they had to end QT and start balance sheet going sideways to up. I think we're going to see a similar thing happen, maybe 2024. Still hard to judge at this point. It partially comes down to what Treasury officials do. I mean, they could, for example, reduce their long duration bond issuance and increase their short duration bond issuance, which allows them to pull money out of reverse repo more quickly and help control yields. You could see some central bank coordination. But in general, um, I think bond yields are going to be sticky to the upside unless until you have a reversal. And so that doesn't mean it's not tradable. If you see, like in recent days, there's been a little bit of a bond bid because of, instability. So people naturally reach for things like gold or bonds. Maybe that gets legs to it. But it's not a very attractive risk reward in my view, at this time. I think that's structurally still a supply demand problem.
Hmm. Well, Doug Casey always tells me that bonds are the worst things you can buy because you have all sorts of risk, like counterparty risk, there's currency risk, there's rate risk, and all these things. And it's kind of funny because when you think about gold, which is a not non-yielding asset as it is, they call it a pet rock. It still catches a bid in these situations, as you mentioned. So there's an interesting developments here. They all keep pointing for me sort of towards this commodity cycle that is in the making. People ask, when is it going to come? And so far, what you're telling me, I'm getting the answer that, well, it's already here. It's already in the making, right?
Yeah, I mean, I think you see that also when you look at oil prices, when you look at energy producers. I mean, a lot of those are up significantly from their lows. We've seen a lot of action out of uranium lately. Some of that thesis has started to really play out. Um, Copper is more cyclical, so that's been a little bit more pressured, kind of during this tightening period. I think, generally speaking, when you have a very tight Fed and a very strong dollar, those are massive headwinds against commodities for at least for the period of time that they're able to sustain that, right? So it shouldn't be surprising that commodities have headwinds while they're able to do this. Whenever you see the balance sheet going down, um, that's it's not the only variable, but that's a big headwind against commodities. I think the way to look at this is, what are commodities going to look like in, say, the 12 to 24 months once the Fed is no longer able to get their balance sheet down anymore, once they stop going down. That's generally the part I'd want to be very long commodities. And, some commodities I'm already long. I mean, I've been sitting in uranium for 3 years. I've been sitting in energy producers, and the cool thing about energy producers is a lot of them are profitable and dividend paying at current oil prices. So oil can go down $10 or $20 a barrel, can go up $10 or $20 a barrel. They are generally these profitable entities. You have a positive carry while you're waiting for what many of us expect to be a structural uptrend in energy prices, after we get past this kind of, this period of pushback and tightening.
Hmm. Uranium, obviously, that's something that I also want to talk about. I've been on and off since 2018 in uranium and talking more about it. I mean, you and I have been talking about it since 2020 or something along those lines in conversations that we've had. And the problem here now becomes for me sort of counterparty risk with uranium because of the quality of what you can put your money in. And so in a newsletter at the beginning of, I believe it was the beginning of September. I think I read it on my birthday. That's why I remember that you wrote was you were saying that you didn't have a clear view on uranium over the short run, but that you believed that holding the physical funds over the long run made sense to you. Is that still sort of your opinion after the recent run up, or has it changed?
That's generally how I've been playing it. I've had some exposure to the miners, but primarily I've been holding the physical funds. I mean, back when I originally got in, uranium was like $30 and you could buy the fund for a 20% discount to NAV. So I was basically buying $24 uranium. And so over time, you benefit both from the gap closing and from the price going up. Um, and I generally still like that risk reward. And the way that someone can tailor that is that they can get bigger size than they can with the miners, on a say, a volatility adjusted basis. So instead of taking, say, a small position in a miner, I might take a bigger position in the uranium itself. But that's also because I'm a macro investor. My attention is focused in multiple areas. I'm not going to sort through individual miners, and like study their geography, geology, and
Mm.
details like that. So there's obviously room for specialists and traders to get a lot more upside in exchange for more downside risk, um, in this cycle. So I don't think there's one size fits all. I think it depends on what kind of investor you are. If you're a larger pool of capital, if you're a diversified pool of capital, owning the uranium itself has been a very attractive risk reward trade. Um, Whereas if you're deep in the trenches, on this specific topic, there's other sources of alpha you can get.
Mm. You make an outstanding point here, and also in addition, if you're sort of a gambler like myself, then you go for the lottery ticket, sort of sub $50 million market cap companies that are. But that's sort of it fits me. That's what I do all day basically, and I try to interview at least one company a day, and so I research companies all day. I still am not making sense of this, so it's no, it's an outstanding point. But okay, oil, uranium. You said energy, so I guess we have coal and natural gas left to talk about. I saw today actually in the news something about Israel and a natural gas field that they're going to be closing or halting or whatever is happening. But natural gas had an outstanding week last week. It broke through $3 very strongly. It's 3.40 right now, but still a very low price if you compare it to where it was in 2022. Germany's restarting coal power plants, which means that probably they don't have the access to natural gas that they would like to have. So what are you making of natural gas?
I'm long-term bullish on both gas and coal. Um, Gas is tricky because it's a very local market.
Hmm.
With most energy sources, the cost of transporting it is pretty small relative to the cost of the underlying commodity. Natural gas is different in the sense that transporting with pipeline or LNG is a costly and capacity constrained, um, mechanism. So if there's just not enough LNG capacity, it doesn't matter what the price is. There's just only so much LNG capacity, at least, until more comes online, which takes time. Same thing with pipelines. Um, you can't just kind of load it onto a ship and just get it out there like you can with oil, for example. And so the less fungibility of natural gas is what gives it more local volatility. Like you can literally have a super spike and then you can go negative. Like that's because it's a market where there's like kind of borders around it. And so when you talk about natural gas, it becomes very kind of geography specific. But in general, whenever there's like a spike in one commodity, there's going to be, I think, and we've already seen this play out in Europe. There's going to be a shift towards other energy sources. So if gas spikes, you go towards coal, and things like that. There's renewed interest in nuclear, which is a multi-year story. But basically, when you try all these other options and they don't work, you revisit the one that works. And so I generally am bullish across the entire energy complex. My focus has generally been on, say, oil and uranium. But for me, it's an all of the above. I think energy in general is going to have a bull market, and is in many cases already started what I would consider a bull market. And I also think eventually copper joins in more. But I've been more hesitant on copper while we're in a tightening cycle.
Hmm.
But in general, I'm bullish on most commodities across the board.
Hmm. You brought my attention to the cash reserves of the oil majors also in a newsletter a couple of months ago. I think, what did you write? I think you must have written about Exxon, that had like $30 billion or something like that in cash, which is kind of funny when you think about it in relation to uranium, which is 180 million pounds a year market, and that's like 11, 12 million dollars. So ExxonMobil can literally buy all the uranium demand twice, with its cash. What do you think that cash gets used for, by the way? And do you think it's going to have any repercussions on some of the valuations, maybe on the smaller companies in the sector, or what do you think they're going to do with that cash?
So I think that so generally what they do is in this cycle, what we've been seeing is, um, energy companies want a buffer so that if they have an oil price problem, they can still pay their dividends. They use the cash for buybacks, but they also want to have a lot of opportunities. This gives them more opportunities for acquisitions to keep their reserves topped up. That's one thing they can do. I do think we're probably going to see, kind of a acquisition cycle where, some of these cash-rich majors buy some of these lower-priced companies with bigger reserves, that they can add to their reserve pool. Um, we also see, if you're a energy company and you're facing all sorts of lack of clarity, right? So Fed tightening, recession risk, geopolitical concerns, political risk, like, random windfall taxes potentially being put on you due to public concerns around energy prices or climate or whatever. Um, you don't have a lot of incentive to like take the money you're earning and plow it right back into the ground. If you can earn 5% on your cash equivalents, um, they can just park it there and have this big kind of optionality fund. They can buy a company, they can protect themselves if oil goes down for a period of time more than they think. Um, it's basically a big flexibility pool. And what I pointed out with ExxonMobil and these other companies is that because they have very strong credit ratings and financial positions, they've been able to lock in long duration, low interest rate debt. So they can issue that, they were in a position to issue like 10-year bonds for like 2% yields. And so they locked in a lot of long duration debt. Now, as cash came in from that period of higher oil prices and still very profitable, they can put it into cash, and that's earning a higher yield than their bonds are. So energy companies are the new banks. Their cash assets yield higher than their bond liabilities on average. And so ExxonMobil probably has as much interest income as it has interest expense. And so there's limited downside for them having a cash buffer at this time. Basically, after they pay growing dividends, after they buy back some shares, they can hold that fund and then have optionality going forward. And it's a very strong position to be in.
This is exactly the type of analysis I subscribe to a newsletter for, that oil companies are the new banks. And I don't know if people are still listening and they're not subscribed to that newsletter. I don't even know what you're spending your money on, but it's lynalden.com, and it's absolutely worth it. Okay, so that's your energy. We went through, I guess, all of it in terms of the energy commodities. But I also saw a headline today saying that, what's happening in the Middle East is already boosting safe haven demand for gold, and you sort of hinted at that as well. But I'm not necessarily seeing that in the gold price. And if I relate back to what happened when with the Ukraine war in, what is it, 2021, gold had that initial spike, and so I had FOMO. I think I might even I bought something and then I lost money on it as well. But it had an initial spike and then it settled down. I didn't care too much about it over a long enough period of time. What are you making of the precious metals in this situation?
I view it somewhat similar in the sense that, I mean, today there's a 1% move to the upside. That can also easily be tied to a fall in real rates
Mm.
briefly, because there's a little bit of, when I say flight to safety, I mean it's a marginal day, right? It's not a spectacular day in terms of most prices of most assets, especially given the magnitude of what happened geopolitically, right? So it's actually been a pretty muted day in financial markets, all things considered. Um, in general, while the dollar is this strong, while official real rates are this high, that does put downward pressure on gold. Gold has held up pretty well for the past, year and a half, all things considered, because we do generally see marginal central bank buying of gold over treasuries. We do see people wanting to own some of it. I would fade kind of war headlines. If I was not bullish on gold, I wouldn't necessarily go out and buy gold just because of what happened this weekend. But I am structurally bullish on gold along with other assets, just in the sense that I think the sovereign debt problem is going to be an ongoing, unaddressed issue for the
Mm.
next 5, 10 plus years. I think it's just an ongoing thing. And then you always have the right tail opportunity that central banks can use gold to recapitalize themselves, right? And that's not really investable. Like it's kind of like the equivalent of a Nixon shock. Like there's things that can happen where you just wake up and gold's twice the price it was, and it's not something I would expect in say a 12-month period, but if I say, is this going to happen with the next 15 years? This is a decent shot, right? So it's like gold is a slice that I have in my assets, um, both in terms of a portfolio holding, but also it's one of the handful of assets that are bear assets. So things like physical gold, things like self-custodial Bitcoin, these are assets that you can hold in your possession that no one can take away from you with a stroke of a pen.
Hmm.
If they want to get them from you, that's a lot more frictions to do it. They need more legal challenges or physical challenges. Bearer assets, I think, are worth owning in general in this environment.
Hmm. Well, the 1930s begs to differ, right?
Well, if actually, I would say no because you had very little. No, they didn't go door to door to get everyone's gold because
Hmm.
that would be a death wish, right? And so instead, you had penalties, very few prosecutions. It was basically in a liquid market, and a lot of people just held on to their gold for 40 years. I mean, a lot of that gold was not turned in, and very few people face consequences for it. We also have to consider that happened. So the gold ban happened with a rare supermajority in U.S. Congress. So FDR and his party, that his party had 70% of seats in Congress,
Hmm.
right? They could do anything. They could pack the court. I mean, the things that they were restricted from doing were almost nothing, right? So that's different from being in a very political environment. I mean, a very polarized environment,
Right.
right? And so we're in this thing where you still have some degree of judicial independence. You have, difference of opinion between, what the president wants, what the Speaker of the House wants, what XYZ wants. We have a lot of disunity, which is bad in some ways, but it's also good if you're hoping that there's not like sweeping draconian intervention against things like owning, a benign yellow metal or owning a string of numbers representing
Hmm.
a private key, right? I mean,
Right. I mean, I only, for the record, I'm saying this jokingly because those are basically the two comments that I would get when I talk to someone about gold is, oh, it's a pet rock, so it does nothing, it just sits there. And also, well, the 1930s, they can take it away from you just as easily. Truth is, most people didn't turn in their gold.
yeah,
So that it actually is an argument that sort of defeats itself. You also make a good point that a house divided against itself does not stand, which is literally what we're seeing right now. So getting that through right now, getting anything through right now is almost impossible. Actually, watching
yeah.
what's happening in the U.S. So there's that. No, I think I've been. I assume you don't follow some of the more niche metals like your tin and whatnot.
I've heard the bullish case for tin. It sounds good to me, but it's not a
Hmm.
niche that I'm able to follow due to the things that I focus on. I focus on generally the big macro commodities more so than the specific ones.
Yeah, that's what I imagine. All right. Okay, Lynn, I can imagine you're tired of looking at my face, so I want to close it off here. I have there's something new that I'm trying out. I don't know if it works out well or not. I think I've done it like once or twice, but I'm basically rolling a dice. I'm rolling a die. I suppose that's how you would say the singular format. I'm rolling a die on Google here. It's gonna give me a number. I'm gonna do that 3 times, and then you're basically gonna get 3 questions that you're not supposed to decline to answer. Is that something you want to do?
I'll do my best.
Okay. Let's try. I'm gonna fill my screen just so people know that I'm not cheating. First one's eight. Eight would be what's the biggest sum of money you've lost on one bet, and what did you learn from that?
I guess realized or unrealized losses. Realized losses would be that I had some Russian equity exposure, going into this. I managed the position size carefully, but it was still in terms of overall impact, it was not great. Um, the other one, unrealized losses would be, so I mean, I've been bullish on Bitcoin since it was under $7,000 a coin. It went from 6,900 to 69,000. And so it 10x'd. And then it went down to, under 16,000 back up to 27,000. So the unrealized profits and losses on that position have been rather immense
Hmm. So
and
what do you
they're
make of
structurally
some of that?
well, I mean, in general, I mean, I'm a somewhat conservative investor in the sense that I never go all in on anything. I've never really had any investment loss that I was super concerned about, just some that I was, kind of frustrated about. For me, the Russian exposure was annoying because you had otherwise, like, Luke Oil, for example, the underlying companies themselves are still doing what they're doing. It's just your claim to that company is now either indefinitely frozen or taken from you. And so that's never a particularly fun way to lose money, is to do the work, do the research. You understand the political risks, so you manage the position size, and then it just, doesn't work against you.
Hmm. Still frustrating though, because I bought a Russian gold stock on the day of the invasion because it fell 60%. I was like, okay, well, if it falls more, I'll just add. Surely enough, it fell 70% the next day, but my broker had locked me out of adding to that position. The only thing I could do is sell it. And I was like, okay, I'm just going to sit on it and just wait. I assume a couple of years it's going to get solved or something. And then eventually the broker sold that for me. So it
Yeah.
was something like a 60% loss or even a little bit more than that. So that was painful. I learned that lesson too, I guess, alongside with you there. Okay, let's keep the pace. I'm rolling another time. Now it's working. This is a 14, and 14 is. Mm-mm-mm. Oh, well, this is actually kind of obvious for you, but it says technical analysis versus fundamental analysis and why.
Yeah, so I like fundamental analysis. I like understanding a business's cash flows, prospects, network effects, moats, balance sheet. When I look at commodities, I want to understand the nuances of the supply and demand picture. I want to understand the unit of account we're denominating this in, right? So we're going to expect the dollar to get weaker or stronger over a multi-year time frame. Um, to the extent that I pay attention to technical analysis, if something falls in price a lot that gets me interested, I generally wait until there's at least some semblance of a bottom before I just go knife catching. And so I do look at basic momentum changes, um, basic, overbought, oversold conditions. So I would say I'm 90-10 or 95 to 5 shifted towards fundamentals, but not a pure 100%.
Hmm. Is there any indicator like that, just an RSI or something like that that you look at?
RSI, MACD, just kind of basic, and then price. Just, just like, is it falling? Is it stabilizing? Is MACD turning back up? Just really basic stuff of just, if I'm bullish on something and it's falling, I might as well wait for it to kind of settle and start showing early semblance of turning up. Now it could easily be the case it starts turning back up and then falls again, right? I mean, that's, you're not precluding that possibility, but it's like it still gives you the probabilities shift more in your favor if you at least wait for price to start confirming a little bit.
Hmm. Is that something you do often, catching or trying to catch falling knives and then thinking, oh, but if it keeps falling, I'll just add on a little bit more?
So I'm a value and contrarian investor at heart, kind of. So if something is low sentiment and not doing well, I tend to at least want to look at it and
Hmm.
analyze it. Um, I don't knee-jerk buy more of something just because it's falling. Um, my I'm always asking, is this falling relative to its fundamentals? If I wake up and there's news about a company or an industry and both the fundamentals are worse and the price is worse, I don't necessarily buy more. I'm not going to double down on losers. Um, at the same time, it's just an area of interest. I mean, basically, you buy when there's blood in the streets. Uh, so there's kind of those two competing, views, which is generally winners generally keep winning, losers generally keep losing. So there's that, like, one thing to consider, and then there's value investing, buy when there's blood in the streets, don't attend a well-attended auction, that kind of stuff. And so I'm always trying to balance those, which is basically that I don't want to buy lousy assets. I want to buy very good assets and just buy them at a time when they're just not super in vogue at the moment.
Mm. Okay. Being a contrarian for the sake of being a contrarian, obviously
Yeah.
not something that works out. Otherwise, God forbid, you end up owning bonds. I'm gonna roll the die again. 17. This is the last one, and 17 says this is also maybe not applicable to you because it says what advice would you give your 30-year-old self? Let's say what advice would you give your 20-year-old self? I don't think there's any 20-year-olds listening to this, but it'll be interesting. What advice would you give your 20-year-old self?
I would say to think about what you spend your spare time doing. When I worked in engineering, the sign of a really good engineer is that when they go home for the day, they keep engineering. They're tinkering with something, like they're building something in their garage. They're teaching themselves another programming language. They're doing, whatever, like they just can't get enough of it. When I went home, I used to be an engineer, and when I went home from engineering, I would tinker with investing. I would research, whether macro, whether a company balance sheet, whether an industry. I want to understand more and more of finance. And so that's something I would do. It's like it's not even a job because it's just something I want to do. And so I would say find what you're doing in your spare time and then find the intersection of things you do in your spare time that also make money, right? So if you're writing poetry in your spare time, I mean, maybe you'll be Shakespeare, probably not. But if you find yourself kind of leaning into something else, that pay attention to that signal, because success is a lot about being passionate and showing up, because that's what makes you good at something. Is if you just want to find out more and more about it on your own time.
Lynn, this has been awesome. I'm all out of questions. This is something that you came here hoping to talk about, but I'm failing to bring up.
I think we covered a lot. I think basically don't let short-term headlines cloud your long-term analysis. Um, and also, I would just say check out Broken Money, the book that I just wrote. I think it's if you're going to zoom out, long history, long into the future, to get a bigger picture of what's happening now, rather than just focusing on current events.
How many copies of that are out the door, if you don't mind me asking?
So we're closing in on 20,000 copies.
Wow.
It's doing pretty well. It's a category leader on Amazon.
Hmm.
Kind of either the depending on the category, kind of the first spot or the second or third spot for its main category. So it's doing quite well. Given that it's a 500-page financial book.
Yeah, it's very thick. It's got 4.8 stars out of 5, by the way, or out of 5. So congratulations on that. I think what people really so there's a couple of 1-star reviews and I read them. There's 30% of them are 1-star reviews, and it's basically gold bugs complaining about you liking Bitcoin. Well, you probably saw that.
Yeah, and a couple of those jumped on it like the first day without reading it. And I actually knew
Right.
one of them who always just kind of harasses me online. So
Hmm.
yeah, I mean, hate is gonna hate. I like both gold and Bitcoin. So
But also, you did not make the book about Bitcoin. Um,
nope.
I think you mentioned it like halfway in, almost like a third in, maybe you mentioned Bitcoin. So this is not a Bitcoin book for people listening. This is history of money, and I mean, if you're trying to understand money, which you should be, as Lynn mentioned, this is absolutely something you should check out. And also, again, lynalden.com. There is a free newsletter. There is a paid version. Both are absolutely worth the money and the time. So yeah, Lynn, thanks so much for being here.
Thanks for having me.